Hi, welcome back to the channel. My name's Sarah from Meridian Accommodation, and today in this quick video I'm going to talk to you about capital gains tax and how to be as efficient as possible as a property investor. But first, remember to like if you find this information useful, and click the subscribe button below to be notified when I post a new video. Let's get into it. So let's now look at capital gains tax. So Sue and Chris, again, they're both going to buy a property that's worth 100k. Now, in the UK, house prices double every 8 years on average. We're going to be cautious and say that they double every 15 years in this example. So their property that starts out at 100k, in 15 years is going to be worth 200k, in another 15 years it's going to be worth 400k, so on and so on. But Chris, he forgets rule number one. Now, as a reminder, rule number one is never, ever, ever sell your investment properties, and you're going to see why in a minute. But Chris, he forgets this, and he decides that he's going to sell his property at this point here when it's worth 400k. So he's made a 300k gain, and that's illustrated here, so he decides to sell. If he's a 40% taxpayer, then the government says that he has to pay a 28% capital gains tax on this 300k gain. Now that equates to roughly £84,000 here. By the way, if he was a 20% taxpayer, that would come out to roughly £54,000 here that he'd have to pay in capital gains tax. So let's say at the end of all this, after he's paid his solicitor's costs and things like that, Chris is left with £300,000 in his bank account. Now, the other alternative is Sue. She remembers rule number one and she decides not to sell her property at this point here. Instead, she knows that as her property goes up in value, she can increase her debt against it. So she goes and refinances her property and gets a mortgage, 75% of this 400k here. So she gets 300k, and that goes straight into her bank account as well. So what's the difference here? You've got Chris and Sue. They both have 300k in their bank accounts. Well, the difference is that Sue still owns this property. She's only remortgaged and refinanced. She hasn't sold it. So she still owns this property. Now, what's going to happen in another 15 years? Well, that property is going to be worth 800k. What about another 15 years? 1.6 million. So by Chris selling here at this point, he's lost out on £1.2 million worth of growth that he could have had if he hadn't sold his property. So remember, rule number one, never, ever, ever sell your investment properties, and that's how you remain capital gains tax efficient. One more amazing tip for you guys about capital gains tax. So let's go back to this example. Chris bought at 100k, he sold it for 400k, making a gain of 300k that he had to pay £84,000 of tax on. Now, if he'd held on to this property, then on the day that he died, that capital gains tax would have been wiped clean. He would not have had to pay any of this capital gains tax, or his family wouldn't. I'll come on to inheritance tax in a little while because that's slightly different, but on the day that you die, capital gains on your properties are wiped clean. If it had been sold the day before he died, this would have had to be paid. But if it had been sold after, then wouldn't have had to pay capital gains tax. So remember, never, ever, ever sell your investment properties. You need to take these to the grave with you. So I hope you enjoyed this video. If you want to learn more about the benefits of refinancing your investment properties, I will be making a video about this really soon. So remember to subscribe and hit the notification bell to be told when I post that video. As well, remember to give this video a big thumbs up if you learnt something new, and I will see you in the next one. My name is Sarah from Meridian Accommodation. Happy investing, and I'll see you soon. Bye!